Welcome to the deep dive. Today we're really getting into the weeds on UBS Group AG's third quarter 2025 results.
Yeah, this is a big one. It's not just numbers. It's about that massive Credit Suisse integration, too.
Exactly. It's like watching someone juggle chainsaws while sprinting. They have to run the bank and absorb Credit Suisse.
It's a huge task. And,
Mhm.
the CEO, Sergio Armati, he framed it quite well. He talked about strong private and institutional client activity
Mhm.
alongside really disciplined execution on the cleanup.
And the scale is just staggering, isn't it? Invested assets nearly $7 trillion now.
Almost unbelievable numbers.
So let's get to the scorecard, the financials, because there are, well, two key profit numbers here.
That's the crucial starting point. You've got the reported profit before tax, the PBT,
Mhm.
which came in at $2.8 billion,
Right.
solid.
Okay.
But then there's the underlying PBT. That's the one grabbing headlines, $3.6 billion.
Right, and that $800 million gap, why the focus on underlying? Sometimes that sounds a bit like, financial jargon or spin. What does it actually tell us?
It's a fair question. Think of it like this. If you're doing a major home renovation, which UBS is effectively doing with Credit Suisse, your total cost includes the core work, but also all the unexpected stuff.
Like finding faulty wiring or legal fees.
Exactly. Remediation, lawsuits, integration charges. The reported PBT includes all those big, messy, often one-off costs from the merger.
Ah, okay. So the underlying PBT is what? The profit without the merger chaos.
Pretty much. It strips out that noise. It shows the core engine's performance. And that $3.6 billion figure, well, that represents a 50% jump year over year in their underlying operational profit.
50%. Wow. Okay, so that shows the existing UBS business is really firing on all cylinders while carrying this huge integration weight.
Precisely. It tells you the core bank is healthy.
Okay, that makes sense. So moving from the cleanup cost to where the money's coming in, the core businesses, how are the client flows looking? Because they need that steady inflow to fund this whole thing.
Confidence seems pretty solid. Group invested assets climbed 4% just in the quarter, hitting that $6.9 trillion mark we mentioned.
And the powerhouse, Global Wealth Management, GWM.
GWM's underlying PBT was strong, $1.774 billion, which is up 39% compared to last year. Really robust.
39%. But the key metric is always net new assets, right? NNA. Are they actually attracting new money?
They are. And the number's quite striking, $38 billion in NNA just in Q3.
Sits in the quarter.
Yeah. And that pushes the year-to-date total to $92 billion.
$92 billion. Wait, their full-year target was $100 billion, wasn't it?
It was. So they've basically nailed their annual ambition with 3 months still to go.
Incredible. But hang on, reading the details, there was a bit of a catch, wasn't there? Specifically in the Americas.
You're right. There's a nuance there. The growth was really strong in APAC, EMEA, and Switzerland. But the Americas did see some outflows.
What?
UBS puts it down to advisor movement after they realigned things last year.
Okay, advisor movement. Is that just a polite way of saying key advisors left and took clients with them? Or is it genuinely just, expected friction from the merger?
Probably a bit of both, I guess. Mergers always cause some churn. But the U.S. market is obviously huge, so any outflow there gets noticed.
Mm-hmm.
But the good news, really, is that the inflows elsewhere, especially in faster-growing regions, more than made up for it. And also, transaction income in wealth management looked really healthy, up 28% year over year underlying.
Okay. Good recovery there. What about asset management? I saw they hit a big number.
They did. A psychological milestone, really. Asset management invested assets crossed the $2 trillion mark. First time ever.
$2 trillion.
And importantly, that was fueled by $18 billion in net new money. And it was spread across all asset classes. Suggests broad confidence.
Right, not just one lucky bet.
Yeah.
Okay, and the investment bank. That can be volatile. How did the IB do in Q3? Isn't that usually a quieter quarter?
It often is, but they had a record third quarter, which is, as you say, quite unusual.
A record Q3.
Yep. Underlying revenues shot up 23% year over year. Global banking, think M&A, advisory that surged 52% year over year. Big jump.
52%. That suggests the deal pipeline is really humming.
It does. And global markets, the trading side, was also up 14% year over year. Strength in equities, NFRC, that's foreign exchange, rates, and credit.
So they captured the market moves well.
It seems like it. Client activity was strong, and they capitalized.
Okay, so the core bank is performing, generating the cash needed for the integration. Let's switch gears to that integration itself. Operational excellence. The cost savings number jumped out at me.
Ah, yes, this is probably one of the most impressive parts of the report. They managed another $7 to $9 billion in gross cost savings just in Q3.
Okay, $0.9 billion. But what's the cumulative total now?
That brings the running total to $10 billion in cumulative gross savings.
$10 billion. And the key thing I saw was the timing. They hit that $10 billion mark a quarter ahead of their original plan, right? Towards that roughly $13 billion target for end 2026.
Exactly. Ahead of schedule.
So does that mean the target was maybe too easy? Or are they just executing incredibly well?
It points towards really aggressive execution. They might also be finding some synergies are perhaps less complex to realize than feared initially. Shutting down duplicate functions, maybe consolidating platforms faster. Whatever the reason, getting those costs out ahead of schedule shows they're moving decisively. You don't achieve that pace without real focus.
And a tangible sign of integration is moving clients. How's the account migration going? That's often where these things stumble.
It's a critical metric. They reported that over two-thirds, that's more than 700,000, of the Swiss-booked client accounts are now successfully on UBS systems.
Over 700,000 accounts moved.
Yeah. The aim is to get all the Swiss booking center migrations done by the end of Q1 2026. This is, the concrete evidence that the two banks are actually knitting together.
From behind the curtain, the digital side, tearing down old IT systems, that must be a mammoth job.
Oh, it's huge.
Yeah.
They've already retired 1,365 of the old Credit Suisse applications. That's nearly half the ones they targeted.
Of how already gone.
And get this, 66,000 servers switched off. 7 data centers exited completely, 2 just in this past quarter.
66,000 servers. Why does decommissioning servers matter so much?
Well, every old server, every outdated application is a potential security risk, a cost drain, and adds complexity. So this cleanup directly cuts risk and operational spending. It's vital.
Makes sense. And the really tricky part, winding down the bad stuff from Credit Suisse, the non-core and legacy unit, NCL.
That's also moving faster than planned. They cut another $1.9 billion in risk-weighted assets, or RWAs, from the NCL books just this quarter.
Okay.
They've now closed out 94% of the initial NCL books. They're very close to that original end 2026 target of over 95%, basically scrubbing the balance sheet clean and doing it quickly.
Which leads us nicely to capital strength. All this integration costs money and carries risk. They need a strong buffer, right? How are the capital ratios looking?
Very strong. Actually exceeded their own guidance. The key one, CET1 capital ratio, that's Common Equity Tier 1, the core measure of resilience, it ticked up to 14.8%.
And their guidance was around 14%.
Yeah, so comfortably above. And the CET1 leverage ratio also climbed to 4.6%, well, clear of the 4.0% they guide for. So yes, the capital buffer is definitely there.
And that strength allows them to return cash to shareholders even during the merger.
Correct. They bought back $1.1 billion worth of shares in Q3.
Okay.
And they confirmed they're on track to hit their $3 billion total buyback target for the full year 2025. Plus, they're still accruing for a double-digit hike in the ordinary dividend.
So not letting the integrations stop shareholder returns, that's a strong signal.
It is.
Now, litigation. Usually a drag, but this quarter it actually helped the bottom line. Some old Credit Suisse issues resolved.
Yeah, bit of a positive twist there. They reported a net litigation reserve release of $668 million.
A release, meaning they'd set aside too much.
Essentially, yes. The biggest piece was $673 million released because they finally completed all their obligations from that old Credit Suisse residential mortgage-backed securities settlement with the U.S. Department of Justice. Closing the book on those RMBS cases is a big deal.
Definitely closing a long and painful chapter there. But speaking of legal issues, a massive new one, or perhaps a reopened one, emerged regarding those Credit Suisse AT1 bonds, right? The CHF $16 billion write-off from 2023.
Yes. Here's where things get complicated again, moving from operational wins to regulatory uncertainty. You remember the huge controversy when those additional Tier 1 bonds were wiped out during the rescue?
Of course. It shocked the market.
Well, this quarter, the Swiss Federal Administrative Court dropped a bombshell. It ruled that FINMA, the regulators' decree ordering that write-off, actually lacked sufficient legal basis, and it revoked the decree.
Wait, revoked it. So the court said the write-off was unlawful. Does that mean bondholders suddenly get their 16 billion francs back?
Not immediately, no. The court didn't order a remedy like repayment. But it's a huge ruling. Both FINMA and UBS have already stated they'll appeal this to the highest court, the Swiss Federal Supreme Court.
Why appeal? Why would UBS fight against potentially not having to have wiped out those bonds?
It's about the principle and the future credibility of AT1 bonds globally. These instruments are a key part of the bank safety net. If their core feature, absorbing losses in a crisis, is thrown into doubt by courts, It could destabilize the whole regulatory framework. It's a really high-stakes appeal.
Hmm. Okay, so that's a major legal battle looming. Let's pivot to the future, though. Beyond the cleanup. Growth strategy, we saw a big move related to the U.S. market.
Yes, the U.S. is clearly a massive priority. In October, they formally filed their application for a national bank charter in the U.S. They're hoping for approval in 2026.
And why is that charter so important?
It's fundamental for their U.S. ambitions. It would let them build a much broader banking platform there, offering more services, lending, deposits, etc., directly to their wealthy clients, beyond just investment management. It unlocks the full potential of the biggest wealth market in the world for them.
A long-term play. And internally, another big theme seems to be artificial intelligence. They're pushing hard on AI, aren't they?
Oh, absolutely.
Yeah.
It looks like less of an experiment now and more of a core strategy.
Yeah.
The numbers are pretty wild.
Like what?
They reported 18 million prompts used across their various AI tools just in Q3. That's apparently a ninefold increase since the end of last year.
18 million prompts. That's a lot of interaction.
It is. And they now have 340 live AI solutions deployed across the bank. They added 60 new use cases just in the quarter. So it's moving fast, it's operational.
What really caught my eye were the adoption figures, the people side of it.
Right. They appointed a chief AI officer, which signals it's a top priority with clear governance. But maybe more tellingly, 3,000 of their developers are now using AI tools to help them write code. That directly impacts productivity.
And they're training the leadership, too.
Yeah, 250 senior execs, the top brass, are going through a special AI leadership program at Oxford's Said Business School. That tells you they see AI as absolutely core to the future, something everyone needs to understand. It's an organizational shift.
Okay, so let's try and wrap this up. We've seen really strong operating results, especially in the investment bank. Record NNA inflows heading towards their target early and hitting that $10 billion cost-saving mark ahead of schedule. Execution seems, well, pretty flawless on the integration front.
Yeah, the main takeaway is definitely their ability to manage both things at once, run the core bank strongly, and execute this incredibly complex merger. The operational risk seems really well handled so far. The bank looks strong, well capitalized, focused.
But then there's that policy shadow hanging over things, that AT1 court ruling we discussed, plus the fact that Switzerland is in the middle of rewriting its too-big-to-fail rules for banks.
Exactly. And that brings us to a final thought, really, for you, the listener. You see this operational machine running smoothly, hitting targets, capital strong. But then you have this major legal appeal over the AT1 write-off and a whole political process redesigning bank regulation in Switzerland.
So the question is,
How will that legal uncertainty from the AT1 case, combined with whatever new TBTF rules emerge, likely effective 2027 or 2028 at the earliest trim, how will all that ultimately shape the risk appetite, the structure, maybe even the future profitability of this newly dominant Swiss banking giant?
operational success meets policy crossroads, something definitely to watch.
Absolutely. The integration execution is impressive, but the regulatory story is far from over.